Welcome to this explainer. If you've ever looked into the eyes of a business owner who's actively hunting for funding, you've probably seen it. It's this very specific, almost physical mix of sheer ambition and quiet panic. They absolutely know that the right capital can turn their struggling operation into a total market leader, but they also know the wrong terms can quietly suffocate everything they've poured their blood, sweat, and tears into. So today, we're diving straight into this incredibly fragmented financial landscape. We're going to break down the tools that can either save or scale your business, drawing directly from expert insights, top lending firms, and government reports.
Okay, let's take a super quick look at our roadmap. We're covering the business funding divide, SBA's patient foundational growth, alternative lending speed advantage, unlocking your trapped capital, navigating costs and protections, and finally, the future of underwriting. And I want to reassure you right up front, we are going to fairly and honestly explore the incredible complementary aspects of both government-backed programs and alternative lending options. Because there really isn't a one-size-fits-all, but there is absolutely a right tool for your specific timeline. Section 1. The business funding divide.
Underneath all the jargon and the endless marketing noise, the entire lending ecosystem basically splits into two opposing camps. It's essentially patient capital, built for forecasted, structural growth, versus highly flexible capital, built for immediate, daily operational survival. You really have to know which game you're playing before you ever ask for the money.
Section 2. SBA, Patient Foundational Growth.
Let's start with the undisputed heavyweight champion of the long-term game, the SBA. Now, a lot of people mistakenly think the SBA just hands out cash straight from the Treasury. They don't. The SBA actually acts as a guarantor. They step in and tell a commercial bank, hey, if this business defaults, the government will cover up to 85% of your loss. That drastically reduces the bank's risk and opens the door for some truly fantastic terms. But what's absolutely fascinating is a massive structural policy shift that just happened. To account for inflation and modern supply chains, the SBA doubled the cumulative borrowing limit to a staggering $10 million.
That is a complete game changer for capital-intensive businesses. It changes the mechanics entirely. Let's say you're running a growing manufacturing firm. Under the old rules, buying a new building might have eaten up your entire borrowing capacity. But now, that same firm can simultaneously secure a 25-year 504 loan for a brand new facility while snagging a 10-year 7A loan to cover automated sorting belts and forklifts. It's an unbelievably powerful mechanism for highly calculated expansion.
Section 3. Alternative lending, the speed advantage.
But here's the obvious friction point. The SBA is notoriously slow. It's built for planned growth, so a standard SBA loan takes a grueling 30 to 45 days. When time is your ultimate enemy, when you need cash to solve a literal burning problem right now, we pivot to the alternative lending market. Here, speed is the primary product. Based on data from leading alternative providers like ROK Financial, Ryo Capital, and Lexington Capital, we're talking about a totally different universe. Applications take minutes. Decisions happen in 24 hours. Funding can hit your bank account in 1 to 3 days, and sometimes on the exact same day.
How do they do it? Well, alternative lenders fundamentally revolutionized underwriting. Traditional banks look backward, right? They want years of tax returns. Alternative lenders don't care as much about the past. They use algorithmic software to analyze your real-time daily cash flow directly from your business bank accounts. So if you only have 6 months of operating history, maybe your FICO score is hovering around 500, but your daily data proves cash is flowing right now, they're going to fund you.
Section 4. Unlocking your trapped capital.
Now, let's explore what happens when your business is actually doing incredibly well. Your balance sheet looks amazing, but all your liquid cash is physically trapped inside the mechanics of your industry. This is the classic liquidity trap. Enter AR financing, accounts receivable financing. Think of a trucking logistics firm holding a $100,000 invoice on net 60 terms. That means they don't see a dime for 2 months. But they can't wait 2 months to buy diesel fuel or pay their drivers today, right? AR financing bridges that massive gap by immediately advancing 80 to 90% of that invoice. One of our expert sources used this brilliant analogy, calling it a time machine for your cash flow. It perfectly captures what you're doing. You're literally reaching into the future, grabbing the money you've already legally earned, and bringing it back to deploy today.
Purchase order, or PO financing, solves the exact same problem but at the opposite end of the timeline. Picture a mid-sized contractor who just won a massive municipal bid. Huge victory! But then reality sets in. They need hundreds of thousands of dollars in steel and lumber before they can even start. With PO financing, the alternative lender steps in and pays the material supplier directly. The contractor gets their steel, finishes the job, and the lender gets paid when the contract finally settles.
Section 5. Navigating costs and protections.
While these alternative tools are absolute lifesavers in chaotic moments, we have to relentlessly examine the financial realities here. What is the true cost of speed? Say it's a Friday afternoon and a restaurant's main walk-in freezer just dies. A merchant cash advance, or MCA, can instantly inject $15,000 with zero collateral so they don't lose the weekend dinner rush. But make no mistake, you are paying a massive premium for that ultimate speed.
You absolutely must audit the fine print. Short-term, zero-collateral capital can carry implicit interest rates starting at 18% and go way up from there. You might see administrative fees exceeding 5%, and if the daily sweep, that's where the lender automatically takes a fixed percentage of your daily credit card sales, if that's too aggressive, your lifesaver loan quickly becomes an anchor that drowns the business. You have to ensure enough margin is left over to actually operate.
Now, for truly catastrophic events, like a Category 5 hurricane, a broken freezer is literally the least of your worries. For disasters of that scale, we pivot all the way back to the SBA, specifically their disaster loan program. And this program brilliantly shifts the entire financial model from just reactive recovery to proactive hazard mitigation.
This is just an incredible piece of policy. If you secure an SBA loan to rebuild after a disaster, you can actually request an additional 20% on top of your verified damage amount. The catch? You have to use those extra funds to proactively armor your building. We're talking about retroactively installing hurricane roof straps, impact-resistant skylights, or industrial sump pumps. It mathematically ensures your business survives the next storm, which protects both the business owner and the taxpayer. It's a win-win.
Section 6. The future of underwriting.
True financial literacy is all about meticulously matching these financial tools to the exact timeline of your business. But that timeline itself is on the verge of massive disruption. Look, during the pandemic, unprecedented speed led to unprecedented fraud. To combat this, the SBA recently expanded a major partnership with Palantir Technologies. They're using advanced AI to instantly cross-reference synthetic identities and fabricated payrolls. And it's working. They caught over $10.5 billion in suspected fraud in milliseconds.
Which leads us to a truly fascinating technological question. If big data can already instantly map out and verify the complex financial reality of millions of businesses just to catch fraud, well, it's going to soon be able to perfectly underwrite legitimate SBA loans just as fast.
So, I want to leave you with this final, provocative thought. Imagine a $10 million SBA approval hitting your inbox before your morning coffee even gets cold. That completely changes the landscape of what is possible, right? The dividing line between the stability of the SBA and the sheer speed of alternative lending might just disappear entirely. Keep questioning the systems, keep auditing your tools, and keep learning. Thank you so much for joining me for this explainer.